Hello and welcome to the LSR Weekly View. After the Brexit leave vote in the UK, which was unexpected, the market reaction so far has been quite muted, really. Crucially, there's little sign of contagion, certainly beyond European equity markets to elsewhere in the world. And why is this? Well, unlike the Euro area debt crises of 2010 and 2011, and certainly unlike the financial crisis in 2008, 2009, there aren't any signs of stress in financial conditions or funding conditions for banks. If you look at the 3-month LIBOR OAS spread, even in the UK, which of course is the most exposed to increased volatility and stresses, that spread has increased somewhat. Just before the vote, it was around 11 basis points. It's currently around 25 basis points, but compare that to levels reached in 2010 of around 100 basis points, or what we saw at the peak of the financial crisis, which was closer to 350 basis points. So we're a long way away from that. So there's no real financial stress, there isn't any forced selling, and consequently we're not seeing the contagion that we associate with previous episodes of market volatility. And there are plenty of signs that volatility is starting to decline. You certainly see it in implied volatility for sterling as the currency recovers somewhat. In a note that we put out today, which there's a link to below, we talk about the real effective exchange rate for sterling after the depreciation being around 15% below its long-term average over the last 30 years. It's never been more than 20% below that long-term average, which would be equivalent in nominal cable rates of something like 145. So as volatility continues to decline, then there's plenty more upside risk for sterling than downside risk. We also see the lack of contagion in fixed income markets, where we've had a fairly aggressive widening of around 70 basis points in European high yield, and really no significant widening at all in emerging market fixed income. So much for the market impact. Next week we'll be publishing our detailed UK economic outlook. That will be an update of our in-depth UK economic model and looking at the effects of the vote on the 2-year forecast horizon there. So look out for that. Thanks, and speak to you next week.